is a currency reset. And this is a topic that I've studied since 1987. So in all life cycles, it's a currency life cycle issue. So that means that we will see gold and silver both, because gold is the primary currency metal, silver is the secondary currency metal. This is a currency life cycle issue. And so you will see both in terms of fiat money, you will see both of those continue to rise. And even when I talked about $3,000 on gold or $50 on silver, I'm talking about the spot market contracts.
The speaker, Lynette Zang, suggests we are experiencing a currency reset. They view this reset as part of the currency life cycle, where gold and silver play crucial roles. Gold as the primary currency metal and silver as the secondary one. Due to the currency's shifting dynamics, they anticipate rising values in both metals. They clarify that projections, like $3,000 for gold or $50 for silver, are based on spot market contracts. The speaker, Lynette Zang, is a financial strategist and educator known for her insights on economic cycles, currency markets, and the role of precious metals. She argues that recent 50 basis point interest rate cuts by central banks. However, they believe these cuts reveal central banks' fear of a looming debt crisis. The speaker notes that policy changes typically take 12 to 18 months to impact the economy, and by cutting rates, global central banks are essentially signaling they are prepared for faster inflation. Despite declaring victory over inflation, the speaker suggests this narrative is more about managing public perception than addressing economic realities. Lynette Zang predicts a resurgence in inflation, impacting not only the cost of living but also the stock and real estate markets. They argue that central banks, fearing deflation due to overvalued markets, actively encourage inflation by lowering rates. With global purchasing power already weakened by past inflation, the speaker believes central banks have limited options. They highlight that despite recent rate hikes to curb borrowing, the financial environment remains loose due to abundant liquidity from years of money printing. For the first time, the Federal Reserve is cutting rates in an already loose market, which the speaker views as a significant move. If you enjoyed the video, give it a thumbs up and subscribe for updates. With only 20% of viewers subscribed, help us reach our goal of 1,000 subscribers. Your support makes a difference. Your subscription is a reward for our efforts.
They want you to think, the Fed cut the interest rates by 50 basis points. And they want you to think that that's like a good thing. Like the Bank of Canada just did the same thing. And the way that they're spinning it to the public is we are going to stick this soft landing. But in reality, what that really shows is that the central banks fear the debt wall. They're using employment as an excuse, but you cannot turn a ship in a thimble of water. And what I mean by that is from the moment that the central bank issues a policy statement or goes for some kind of changes, it takes 12 to 18 months to trickle through to actually have that impact. So when we're seeing these moves from these major central banks and the Federal Reserve and the Bank of Canada, they're not just the only ones that are doing this. We're seeing this all around the world. To me, what that has done is it has announced that the global central bankers are actually ready for the hyperinflation, the more rapid inflation. And we've been getting those indicators with the quick inflation that we've all been experiencing on a global basis. That also helps make corporate profits look better, right? Because they get to charge more for their product, sometimes to the pace of inflation, and what we've seen a lot of times not. And so really, I think that the single most significant thing since the last time you and I have spoken is the fact of watching these global central bankers drop their interest rates a half a point, 50 basis points, because what they're trying to do is inspire more inflation when they haven't beaten the inflation that they created to begin with. But they're calling victory. But that's more about perception management than reality. We will see inflation start to rise more rapidly once again as corporations. And we're going to see that inflation. Make no mistake. We're going to see that inflation not just in the cost of living, but in the stock market and the real estate market. And that's what they're trying to do, is everything is so severely overvalued that the natural tendency is for the prices come down of its own weight. But the central bankers are not prepared to fully deal with that deflation. That's their bigger fear. And so what they have to do is they have to create more rapid inflation, or inflation, period. I mean, it makes it simple. Only one way to fight deflation. That's with inflation. Only one way to fight inflation. That's with deflation. But, you can't fine tune it, and we're out of time because on a global basis, again, we are out of purchasing power to inflate away. That's the real problem, right? That's the real problem. They've already inflated away all the value of this stuff just by doing this, because that's the only thing that they really have is printing money, and they regulate that via the interest rates. And so, they increased the interest rates by a substantial amount to slow down the borrowing and spending. But the investment environment never really got tight. I don't care what they blah, blah, blah say. All you have to do is take a look at the shift from banking into private equity. Take a look at all that money that they've created since 2008. That's still sloshing around in the system. Right? I mean, that didn't evaporate. And so you're seeing the central banks. This is the part that scares me, because the environment is already so loose. The investment environment is so loose, so overvalued, and now they're dropping the rates to make it even looser, which I could be wrong about this because I don't know this globally, but from the data that I've read, this is and looking at the charts at the FRED, the Federal Reserve Education Department, this is the first time that the Federal Reserve has dropped interest rates this far into an already loose environment. That's pretty significant.
The speaker notes that inflation affects everyone and everything, so central banks prefer a 2% inflation target. It allows for slow, less noticeable impacts. They highlight that inflation also significantly raises mining costs due to factors like energy and labor. Observing a sharp increase in these costs, they recognize the growing expense of extracting and refining gold for various uses. The speaker, Lynette Zang, discusses growing trade ties between Russia and India as part of BRICS's aim to promote cross-border trade in local currencies. They clarify that, although a BRICS currency has been mentioned, it would likely be pegged to commodities like gold, not fully backed by them. This distinction is critical. A pegged currency is linked to gold's nominal value, but isn't directly convertible into gold. The speaker uses Zimbabwe's Zimgold currency as an example, where pegging led to black market disparities and forced revaluation, something that wouldn't happen if the currency were truly gold-backed. Now, let's dive into the interview.
I mean, inflation impacts everybody and everything. So when you're seeing it, a nice steady rise, that's why central banks like that 2% target, because the inflationary target, because they get what they want, but it happens so slowly that people don't notice it. They don't take it into account. Well, the inflation, again, has an impact on everything with mining. And actually, Charlotte, you probably know more about those all-in costs of mining than I do, to be perfectly honest with you. But I know how to read a chart, and when I see those costs go up like a hockey stick, I know there's a lot that's going on between energy and labor and many other factors that go into pulling the gold out of the ground and then refining it in a way that it's useful in all the different segments where it's used. And the more solid relationship between Russia and India. So, they've come to some trade agreements, and that's really what the BRICS is about, is creating a unified trading partnership with that cross-border, so that bilateral trade in the internal currencies. I haven't heard anything about the BRICS currency yet. And if that's going to be a unit, then I think people really need to understand that that's going to be a pegged currency, not a backed currency. And I think it's significant that people understand the difference between the two, because Zimbabwe, right, in their infinite wisdom and attempt to regain the trust of the public, said that their new currency, the Zimbabwe gold, was backed by gold, but it wasn't convertible into the gold. It wasn't backed by it. It was pegged to the nominal price of it, right? So that's the difference between those two. And from what I can see from the BRICS currency, and we'll see, they're talking about having a basket of currencies like the SDR over at the IMF. It's a basket of currencies with a component of gold in there, a certain percentage. But quite honestly, unless it is convertible, it doesn't mean anything, just as we've seen with Zim Gold. When the pressure was on and the adoption of the new currency wasn't going that well, they had to do, and so the pricing was different in the black market than in the official markets, and it got wide enough, then they had to do that overnight revaluation. And let me tell you, if a currency is truly backed by gold, you can't do that.
The speaker underscores the delicate balance central banks are trying to strike in today's economic landscape, from managing inflationary pressures to considering the role of assets like gold and silver amid a potential currency reset. They emphasize that while inflation remains a critical tool for central banks, it impacts everything from daily living costs to international trade dynamics, especially within alliances like BRICS. The speaker warns that recent moves by central banks signal an awareness of deeper structural challenges that monetary policy cannot address alone. How might pegging a BRICS currency to commodities like gold impact its stability compared to a fully gold-backed currency? Share your comments below. Don't forget to support the channel by liking this video, subscribing, and turning on notifications for more great content. Stay tuned for the next video.